Are you afraid equities will cause you losses? Do you feel that its risks are too high and rewards too low? This video will change your perspective. Hello and welcome everyone. Wagon presents a simple video that will show how direct equity investing can be the best thing you can do with your money. So let's get started. Let us first educate you about the basic premise of the concept elaborated in this video. We are going to depict how long-term investing can be highly rewarding if done with patience. For this, we will create a portfolio of 8 stocks. The stocks are HDFC Bank, Reliance, Shree Cement, Bajaj Finance, Hindustan Unilever, Asian Paints, Sun Pharma, and Infosys. The stocks have been picked from a variety of sectors, ensuring sectoral or industrial diversification. Also, all companies picked are some of the biggest in India and are known to all. The time period of investment has been taken as 20 years, from January 2000 to May 2021. The first stock is HDFC Bank. Since 2001, it has given a compounded annual growth rate of 20.9%. 10,000 rupees invested in January 2000 would have become 5.82 lakh rupees in May 2021. The next stock is Reliance. Over the last 21 years, Reliance has given a compounded annual growth rate of 15.96%. 10,000 rupees invested in January 2000 would become 2.38 lakh rupees in May 2021. Now we move to Shree Cement. This stock has given a brilliant performance since 2000. It has yielded a compounded annual growth rate of 34.7%. 10,000 rupees invested in January 2000 would become 58.9 lakh rupees in May 2021. Next stock is Bajaj Finance. This stock has been the star performer with a compounded annual growth rate of 41.18%. 10,000 rupees invested in January 2000 would become 1.6 crore rupees in May 2021. The fifth stock is Hindustan Unilever. It has been an underperformer with a compounded annual growth rate of 11.21%. 10,000 rupees invested in January 2000 would become about 97,000 in May 2021. Now we move to Asian Paints. Over the last 21 years, Asian Paints has given a very good return of 27.44%. 10,000 rupees invested in January 2000 would become 18 lakh rupees in May 2021. The next stock is Sunfun. Since 2001, it has given a compounded annual growth rate of 19.17%. 10,000 rupees invested in January 2000 would become 4.28 lakh rupees in May 2021. The last stock in the portfolio is Infosys. Since 2001, it has given a compounded annual growth rate of 12.15%. 10,000 rupees invested in January 2000 would become about 1.15 lakh rupees in May 2021. Now we move to the analysis of the portfolio. An important point to note is that none of the returns mentioned incorporate dividends. A portfolio made of these 8 stocks gives a compounded annual growth rate of 30.84%. So, if someone put 10,000 rupees in a portfolio made of these stocks in January 2000, their investment would generate wealth of over 31.5 lakh rupees by today. The diversified portfolio we have created has outperformed 6 of the 8 stocks in the portfolio. This shows how even one or two great performers can completely transform a portfolio. In early 2000, the interest on fixed deposits was about 10%. If we assume that someone put his money into an FD and received 10% annually for the next 21 years, even then the corpus accumulated would be just 77,000 rupees. The return earned by the portfolio is thrice that of the FD. But the wealth created by the former is more than 41 times than the latter. This shows the power of compounding. The difference between equity in the long term and parking your money in the bank couldn't be more significant and eye-opening. The graph shows the yearly movement of the portfolio. In the entire life of the portfolio, there were only 2 years, 2008 and 2011, when the portfolio saw a dip in its value. Now we define an extreme investing scenario. In this scenario, we assume that an investor puts 1,000 rupees each in 24 different stocks in January 2000. Of these 24, 8 stocks are the ones we mentioned. Total investment is rupees 24,000. By May 2021, 16 of the 24 companies go bankrupt, and the investment of 16,000 in these stocks becomes zero. Basically, the success ratio of investing is just 33%. 2 of every 3 companies that the investor invested in failed. The only 8 companies that remain in the portfolio are the ones we spoke of. Despite such an extreme situation, the portfolio still gives a compounded annual growth rate of 24.29% over 21 years. Out of the 24,000 that were invested, 16,000 got wiped out, and the remaining 8,000 became over 25 lakh rupees. This example is extremely important to understand. In long-term investing, the scope for error becomes very wide. You can afford to make mistakes. Also, there is no real limit to how much a stock can rise, but you can only lose the amount you have invested. This means that even a few good investments can more than cover up for many bad ones. We hope you understood how long-term investing can reap incredible benefits while keeping the risk element low. Wagon is working to expand financial and investing literacy, and we will continue to come up with similar videos that benefit the common investor. Thank you.